Hey guys, welcome to this session. If you wasn't around last week, we did a live stream through. I say we did. Atu from the Darwin THA did a live stream through the NFP result, and we wanted to do this session just so that we could jump back on and do kind of a review of what happened through the session, Atu's perspective of the data and how to interpret it, and then we're going to go through some of the questions that came up from the community last week. So I'm going to hand the session over to Atu now. I will be here to monitor the chat. So if you have any questions as we go through it, please just drop them in the comments, whether you're watching on YouTube, Instagram, or Twitter, and I'll make sure to get those questions answered today. So Atu, over to you.
Yeah, thanks, Kieran, for the intro. Going to share the screen on the sort of screenshots, what happened on the NFP. Just a second. Yeah, so can you see the screenshots? Yeah, I think we can. I can't hear you, Kieran, anymore, but I think the screenshots
There we
are...
go. Sorry, I'd muted myself, but your screen's showing now.
Okay, perfect. Well, good. So, like a quick rundown, what happened? Obviously, it was quite hot print, and we had the big move down on or up in the USD. But it was kind of like what we anticipated, that even with the hot print, you are not going to see much follow through. And we were a little bit surprised that the move was so small, in a sense that, it kind of stopped moving after 4 or 5 minutes on the euro dollar. That being said, there was a clear logic for that, as we outlined kind of the market context for the NFP was that a strong print wouldn't be as important as a weak print. I think Fed pricing declined from 20% to 5% or 10%. Obviously, that's a moving variable, but when the Fed pricing doesn't move significantly, that's a warning signal that this thing might not be moving much more. Now, we were actually looking, the trade we were looking here was the mean reversion trade on the euro dollar. We were looking after ISM if the move continued a little bit more to go long on the euro dollar, but obviously that evaporated very fast. So when the ISM came out, the NFP was pretty much priced out in the euro dollar. That's an important point here, right? What we talked about pre-event on the instrument choice, that can really make or break your trade when you trade events, in a sense that obviously if this number was like judged meaningful or like extremely hot, probably USD yen would have been the instrument that would have gone significantly up. But yeah, that's pretty much in short what happened. We obviously saw the full mean reversion already here, and ISM came broadly as expected, so there was no real trades for us in this case. But hopefully it was kind of like a good showcase, because I think this can be very counterintuitive to people and hard to understand when you see like a hot print, right? The NFP came out 50K more than expected, and especially the unemployment rate was significant deviation, actually 0.2% lower at 4.1%. So you kind of, I think the first intuition for most is to assume that, okay, this is very hawkish for dollar, very good thing for the dollar. But when it doesn't have like implications for the central bank and in a macro context, oftentimes this kind of mean reversion can happen. And yeah, but that was pretty much our playbook for the event. So Kieran, happy to take any questions that were during the stream.
Okay, I've actually got a question before we go through the questions that were on the stream. So when you're looking to take a position post news event, are you more interested in if figures came in line with expectations, you would kind of walk away and say, well, there's no trade because there's no anticipated volatility? Or are you looking for when there's, maybe NFP comes in way out of whack and you go, well, there's going to be some form of reaction here because analysts were expecting X, Y, and Z, but actually what has happened is A, B, C. So what's your preferred kind of environment to trade in?
Well, I think the key edge for us is really in understanding the context and leveraging history because, in a sense that you can think that you can have a huge deviation from expected, but if it doesn't have implications, then you are not going to see momentum there. Yes, we trade momentum. We look for those instances where we have, depending on conviction level, where we will see follow through on the price action. And of course, key part of the edge is knowing when not to trade. Like instances like this didn't fulfill the criteria. That being said, when we trade mean reversion, that's going to be, if we think like, let's say the euro dollar, for example, went down a little bit more, and the ISM came out broadly as expected. That would have been possibly a trade for us because of a small sort of conviction trade, because momentum is really our forte. But still, that would have been sort of filled the mean reversion criteria for us as well. So yeah, we don't look at the deviation from expected. That can be sort of a red herring, I suppose, in a sense that a lot of people focus on, this was a huge deviation from expected. But I think, broadly speaking, most like sophisticated market participants know that the market reactions can be counterintuitive, and you're gonna have to understand when it has a meaning and when it doesn't have.
Yeah, of
Hopefully
course.
that answers the question.
Yeah, and I guess you only sort of get that intuition and know how after doing the same thing for years and years and years and knowing what's kind of I've seen prints before, regardless of what the data is, when it comes in seriously out of line, and you kind of think, well, who was expecting the figure to come in so out of whack, like, so out of sync with what reality actually is? It just, anyway, that was just a personal question for me. But one of the questions which I think is really interesting that we had last week from Typhoon, who's one of our members in the Discord. He asked, because for those of you who were unaware, last week it was July 4th, which basically meant it was a bank holiday in the US. And so they actually moved NFP from Friday to a Thursday. So NFP is always the first Friday of every given month. But this was the first time I've ever, or at least the first time that I remember NFP actually being moved to be on a Thursday because of the US bank holiday. So Typhoon said, did you expect a lesser reaction than typical with many markets closing early and of course the market being closed on the Friday? Or did you just treat last Thursday the exact same as you would with any other NFP release?
Well, it's an interesting hypothesis. I personally don't think it had a meaning. So if this number actually was important, or I think for example, for the USD yen, it would have moved much lower on a weak number. It was more of a function of the number kind of not being, even though on the headline looking like a big deviation, but not having too much implications. That being said, I think when you are approaching hypotheses like that, you kind of would like to test and see and find a certain sample size to actually make a judgment whether it has implications or not. So I cannot definitively answer the question, but I personally think it didn't have implications.
Okay, cool. Wester Prince asked, where did you learn how to do this? Which I know is like the most broad question you could possibly ask. But how did you get into macro trading? I mean, I guess you started a while back, right? You started learning 10 plus years ago, and the majority of traders who come through now, whenever they're exposed to the market for the first time, it's usually by some person who's selling a course or mentorship using charts as their way to get you in. So like, here's a chart that I understand, but you don't. I will teach you how. So most people go in learning technicals first these days. How did you get into macro trading as opposed to, chart work and technicals?
Yeah, it's a very broad question. Well, I think it was pretty much. I just saw that the news moved the markets kind of most, and I biggest volatility moments trigger around news, and I found that fascinating, and because of that, I started studying them, and that's pretty much it. But obviously, it's been a while back, so and things have obviously improved. I guess back then there was much less sort of education on trading.
Hmm.
You really, what you had to do is, go out there with Google and search for news and search, and then of course read books about trading mainly. But nowadays, you of course you can leverage chat gpt, you can take courses, um, all these things. So it's a bit of different world. That being said, of course it can be a double-edged sword in a sense that learning on a poor course puts you back, and
Hmm.
using chat gpt can as well lead to kind of shallow learning. So yeah, but yeah, that's how it went for me pretty much.
So you were self-taught. You didn't necessarily have a mentor who came in and said, "I trade macro. This is what I do."
No, I never had mentors. No, no, I don't think that's a good thing. I think having a mentor can significantly accelerate your learning. So it's kind of like if you start working out and you go to a gym, you if you don't know much about working out, you're probably better off by hiring a personal trainer to teach you like a proper way to squat, for example. Because then if you learn the wrong way, it takes you a lot longer to learn the sort of right form and unlearn the bad habits. So yeah, I think so. Think that it's definitely beneficial to have somebody kind of showing you the ropes at the start. But yeah, I
Yeah,
guess
of
I
course.
guess I kind of learned the hard way.
Yeah, of course. And I completely agree. Having somebody who doesn't, they don't necessarily let you avoid the mistakes that you go through, but they help you overcome them. So instead of saying, these were my mistakes, don't ever do it, it's like, well, you still need to go through your own mistakes, but I'll be here to guide you and to help you
Well,
overcome.
exactly. It's kind
Yeah.
of precisely. It's kind of like with kids. Obviously, you can't. I mean, everybody has to do the mistakes, but I guess like having a good mentor can significantly speed up the process and teach you the right ways to react when you do mistakes and so on.
Yeah, 100%. So we had another question from Amin Assad who asked, where can I get IV data for multiple assets?
So implied volatility data. We use Thomson Reuters. That's paid, but I think you can. There's ways to do it free. Um, like most of this can be sort of the research side can be actually done done for free. So I think like the way I would approach it, I would kind of test chat gpt and ask it for sources, then I would verify the sources, like try to check from the sources. Not always you're going to find that way, but we use Reuters to get the data, and I think oftentimes you have on free sources somebody, for example, comments that implied volatility is this. So there's many ways to skin the cat there. I mean, you can calculate with options pricing if you can obtain that, and yeah, if you have Bloomberg, you can get it from there. So
Uh, just had a message from Sonny saying, Kieran, your volume is low compared to THA. Can barely hear you. Is this any better if I pull my mic closer? I mean, it says that it can hear me. I just don't know mic volume. Let me turn that up. Maybe now. Is that better? Um, so okay, perfect. Whilst I wait for Sonny to come back to me and confirm that you can actually hear me. Yes, better now. Perfect. Thank you very much. So we then had, I say a question. There's like four questions in one from Excel Delugo, who said, "Please, can you explain the third trade? Why would you want to fade the move if there's a positive surprise to the NFP rather than expect a continuation? Also, how do you intuit the relative importance of events?" I'll go over the other three questions,
So
linearly
that was
after
the
you've
first
answered that.
question.
That was just the first one.
Well, I guess I kind of explained um, already when the number doesn't have really a meaning. Why you would want to mirror that? Why you would want to, you know, for example, if you think that there are other drivers that are much more important, the conviction levels can vary on that. So so yeah, when the number is not that important, you might want, for example, you have a strong trend in euro dollar. Number isn't important. That might be an situation where you definitely want to look for fades. Because it's the human nature to go kind of with the number and react to the surprise, right? Overreact to the surprise. So it makes a lot of sense because in trading, most people end up losing money, right? So doing the opposite of what most people do is more likely to yield you money.
So you're basically saying like the number is just one small variable out of a whole bunch of other variables that you've got to understand before you press that button, regardless of whether you're a technical trader or trading like yourself after a macro event. The number is just one part of this whole story, and it's not about
Co-
ignoring that and going the number is positive and therefore let's continue. It's like, okay, well, what does every other variable that I look at say?
Correct. That's a very good summary. So and you can't, but you can't take the conclusion that you should be fading the numbers every time, right? Either. Sometimes you do see momentum. Let's say we had the inverted situation here that the print came out 40K, 4.5% unemployment rate. I'm pretty sure that the USD would have collapsed.
Mm-hmm. Mm-hmm. This same person Excel asked. Also, you talked about a macro setup. Are those based on news events or expectations? I guess we've already kind of discussed that, so we'll move on because we've discussed that twice now. Do you take into account positioning prior to these events, and how do you do this if you do?
Yeah, positioning, of course, it can be very important. It can be also kind of misleading as well. Like big players might not react to, obviously they don't usually react to single prints. Sometimes they do. Last year we had the August NFP, which caused the carnage, and obviously you had a lot of big players reacting to that. But yes, we always look at the positioning, and before the event, it can sometimes feature in, sometimes not. So that was one reason why we really liked the USD yen. eh, In a case that this was a really hot number, like really hot in terms of even bigger deviation, we might have put a small long on the USD yen because the positioning on the pair is, or at the time was very sort of short. It's a very popular trade. But that being said, we equally liked it for the short trade, even though the positioning um, is is very short USD yen, because it would have made sense from an economic perspective for even more people to pile in on the same trade. It would have been risk negative also if the print came out horrible. So positioning can be a bit misleading. Something can be, like I said, I think I said on the stream that something can be, market can be long for something for a really, really long time, right? And it still keeps going up. Same thing with shorts. So you can't just say that, okay, everybody is long equities. It can't keep going up. I think there's a very good source for understanding kind of the impact of positioning, and he even has a process built around sort of news failures and positioning. I recommend looking at Jason Shapiro's work.
Yeah, Jason Shapiro. Yeah, I've studied him quite a bit. And then the last question from Excel was: you also talked about market cycles and how they affect the relative importance of events and expected market impact. How does this work? Thanks, and sorry for asking too many questions.
Yeah. Well, that's again quite broad question. Trying to think how to answer it like quickly. You have sort of different growth regimes and different inflation regimes, and depending where you are in terms of growth and inflation, you might have different kind of market reactions two events, and certain events are more important in different markets. So, and it depends also what's kind of the primary narrative driver. Right now, it has been tariffs since the start of the year, pretty much tariffs, trade talk, and that's the implications of that to growth and inflation. So in that kind of market environment, you don't see as usually as large market reactions to data points, for example, because the market implicitly discounts kind of whatever the result of the trade negotiations is going to, how it's going to filter to growth and how it's going to filter to inflation. So yeah, hugely important. If you want to trade news events, you kind of have to understand these things.
Mhm. We just have two more questions left. So if there's anybody watching now who also has a question, feel free to post it in the comments and we'll go through it now because we only have about half an hour or so. So we've got about 10 minutes left on this session. So we have a question from CB Compound who asked, how important is it for your strategy to get ultra fast access to the release data, or is it rather of secondary importance?
Not hugely important. Well, we have fast access with our service providers, but in the end, it depends on the interpretation, and that's really our edge. We are really quick with the interpretation. That since we have the prepared sort of scenarios, we know our thresholds, triggers before the event, and our analyst is capable of calling the scenario usually within 1 to 3 minutes. Even sometimes in 20 seconds when we have really, and I'm not talking about data only. Actually, for economic data, it's really quick. I'm talking about central bank decisions as well, or we have political events. So yes, we have the same data. I don't think you can have too much edge nowadays with in terms of speed of data. Most people get it quite quickly, and so it really comes down to the skill of interpretation.
So just as a follow up to that, how is there usually a period of time, like a gap after the data is dropped or after the event is announced before you actually start executing? Because as we all know, spreads can widen massively on the actual drop. So I presume you're not clipping it as like you see a number pop up on your screen and you go, right, buy or sell. I presume there's a period of time, right, where you go, okay, let's wait for that to settle down.
For sure not, and it depends on the instrument a lot. So if you trade minor pairs, for example, well, in all pairs we fragment our positions.
Okay.
For best execution, you have to fragment it. Sometimes, depending on the liquidity, sometimes you can react within the first minute. Some depending on the pair, for example, on euro dollar and USD yen, that's not a problem. But yeah, in order for us to build the position, it's usually, if we are trading aggressively, it's within the 5 minutes, not like clicking and going, right. That's it's kind of basic stuff what you do with a bit higher AUM.
So I presume you have, and I could be completely wrong here, but let's say you're looking to get long euro dollar. You would have your area where you say this is my target and where I'm looking to exit, or this is where I think price is going to go if I'm correct on the position, and this is where I want to be out. My entry is less important. It's not like I'm clipping a specific level. It's, can I get my implied size off within these two limits? So price A, price B, can I get my full clip off to get to price A or price B?
Partially yes, but the entry is still always important. The entry, like from a risk reward perspective.
Of course, yeah.
So of course the entry is important, and let's say something that can happen is that we get our initial position in at very good levels, and the market already moved and we are profitable already, and then we are not going to push it at worst prices.
Yeah, yeah.
We're probably looking for some sort of stabilization before adding the size, because it otherwise it would of course distort the risk reward, right. So yeah, when trading news, the entry price is very important, no question about that, but ultimately it comes down to how the market interprets the event.
Awesome. I apologize for taking over with the questions there. I just super curious.
No
We
problem.
then had Mattis who said huge dump on euro dollar, which there was at the time. Although that's not a question, but there was a big reaction on euro dollar. And then Kaneki said, "Do you have access to some more?" Well, same question as before. Do you have access to some ultra fast channels for the numbers?
No, that's I think it's like a common misconception that it makes such a huge difference. It doesn't make such a huge difference trading the spike or because you are
Mhm.
faster than others. Um, yeah.
Well, I think there's a difference there between like market makers, right, and a retail trader. Like a market maker, milliseconds would make the world of difference because they're positioning the market essentially. Whereas you, when you're trading the reaction, it's not like milliseconds. It takes a while for our brain to even compute that, right? So I
Correct.
guess it's. I mean, I'm talking without the experience. I don't trade the same way that you do, of course, so I don't know if it's important to you, but. Yeah, it's interesting that that question's popped up a couple of times. Is that people are worried about the speed of data and how you deal with that. But you said you use Reuters, right?
Yeah, we use Reuters for the news. Yeah.
Yeah. What's your favorite event to trade? If you
Uh,
had to pick one, and we
uh,
we will we will wrap it
ECB,
up in a moment.
European Central Bank during the tenure of Mario Draghi.
Okay.
Um,
Okay.
but I would say that nowadays, I think probably there's no favorite event per se, in the sense that
Or do you have? Let's
yeah,
rephrase
there's no
that. Do
favorite.
you have a most profitable event?
That
Because I
really
know by
varies.
your record, your Thursdays outperform the rest of the days completely. Whether that's you executing on the Thursday or closing trades on Thursday, I don't know. But to me, it's kind of funny that US events are usually stacked mid to end of the week, and that's when the majority of your return comes. Is there something in that? Is there an event that's specifically profitable for you, or?
Well, I think it's the reason for that is because on Thursday you have most of the central bank events always happen on Thursdays, and
Yeah,
even after the Fed, if you see follow through to the Fed reaction after Asia, you see it on Thursdays. The Fed is on Wednesday usually, um, and then you have Bank of England, you have ECB, you have SMB on Thursday. So of course there's some correlation there.
yeah. So you're more active on a Thursday, basically.
Yeah.
Okay, perfect. Well, Atu, that's all of the questions that we had from the session last week. We haven't had any more come through whilst we've been on the session. So what I think we should do is potentially, if some more questions come through over the next few hours, or as people watch this later on in the day, maybe you and I can get together and maybe do some form of written explanation if there's any good questions that come through, and we can do some form of kind of like not a written interview, but just like I'll pose the questions to you and you can give some answers and we can send that out to the guys, because I know there's probably a lot of people who can't come to this session at midday. They might be at work or doing whatever they do. So but I really appreciate you coming back on and doing this review with us and answering the questions from the community. I know it'll be massively appreciated from their end as well. But I know that you're short on time today, so we'll call it here. Thank you very much for joining us, and we'll catch you in the next one.
Yeah, thank you so much for organizing this, Kieran. Yeah, happy to
It's a
answer the
pleasure, dude.
questions. Yeah,
It's a
take
pleasure.
care.
And guys, thank you all for watching. We'll catch you in the next stream. See you all later. Bye bye.
See you.